In the next few segments, we're going to specifically address some key differences between owning and leasing. The first one we'll do in that series is, what are my upfront costs? In a purchase situation, generally, you're going to be putting down, if you pay cash for the truck, obviously, in the example we began with earlier, you'd be paying $75,000 plus whatever tax and titling that it took to actually put the truck on the road. If you're financing the truck, generally you're going to be putting down 10 to 20% of the cost of the truck to be able to take possession and begin your payments with the bank. In the case of a lease, by comparison, very often that payment will be equivalent to a security deposit that is equivalent to your first payment, or approximately what your first payment would be. But a key difference is that security deposit is something that is returned to you at the end of the lease, as opposed to where you've owned the truck, whatever you put into it, that you're going to be completely dependent on that truck holding any value at the end. And if you're the one running it to the very end, it's probably not going to really have any value to essentially return to you. Whereas with the lease, your security deposit, you're opening up the opportunity to use this truck. You make your payments. At the end, you get your security deposit back as long as there's no damage. And it's a cleaner experience to where the point of entry is not nearly as painful on the lease side as compared to the finance side. Let's talk about budgeting for just a minute. When you purchase a truck, and when I say purchase, I mean you put your 10 or 20% down, you finance the remaining amount through a financing institution. In those instances, when it comes to reporting, and all contractors should have a foundation in place to be able to report on their operation so that they're not missing anything, and they can tell their bank, they can tell their third parties how well they're doing, or point to the concerns that there may be at different points of the operation. Ultimately, financing that truck, you've got a payment that's broken up into principal and interest. And so the cash that is going out of your organization to pay for that truck is going to be reflected in two different places. The first is going to be on your balance sheet. It's going to be a reduction of the liability that you have on your balance sheet. The other component to that payment will be interest expense. And that amount will be something that is just reflected on your income statement and will actually reduce the amount of your payment from a tax basis. So it'll reduce the amount of tax that you have to pay because it's offsetting the revenue that you're generating with that truck.